If you're planning to sell a business, a piece of real estate, or a concentrated stock position in New York, there's one thing most people get wrong before the sale happens. They plan around the federal capital gains rate and assume New York works the same way. It doesn't. And finding that out after the sale is an expensive way to learn it. At the federal level, the IRS rewards you for holding an investment. If you sell something you have owned for more than a year, you pay the long-term capital gains rate, which is 0, 15, or 20%, depending on your income. High earners also owe the 3.8% net investment income tax on top of that, so the all-in federal rate for a large long-term gain is usually around 23.8%. That is the system most people have in their head when they think about capital gains. New York doesn't work this way. New York has no preferential rate for long-term capital gains. None. A gain on a stock you held for 15 years is taxed exactly the same as a gain on a stock you held for 15 days. Both get added to your New York taxable income and taxed at your regular state bracket, which currently runs from 4% up to 10.9%. New York treats your capital gain the same way it treats your paycheck. No separate category, no reduced rate, no holding period that gets you a better deal. And if you live in New York City, you have another layer on top of that. New York City adds its own resident income tax, generally between 3.1 and 3.9%, also with no long-term capital gains discount. Put the state and city rates together for a high-income New Yorker, and you're looking at a combined state and local marginal rate approaching 14.8% on top of whatever you owe the federal government. Let me put some numbers on this so it's concrete. Say you sell a piece of your business and walk away with a $500,000 long-term capital gain. At the federal level, at the top bracket, you're looking at roughly 23.8%, which is about $119,000 to the IRS. New York does not care that you built that business over 20 years. That $500,000 gets added to your other income and taxed at your New York marginal rate. Depending on your income level, that could be $30,000 to $54,000 in state taxes alone on top of your federal bill. If you are in New York City, add the city tax on top of that. That is the number most people did not see coming. This matters most in 3 situations I see regularly. Business owners who spent years planning around the federal number and forgot that New York taxes the gain at full ordinary rates with no reward for the time they put into building the company. Employees with a concentrated stock position from years at one employer. Every share you sell in New York gets taxed at your full marginal rate, regardless of how long you held it. And anyone selling investment real estate, whether it's rental property or land you have owned for decades, New York does not care about your holding period. You cannot change New York's tax code, but you can plan around it. Here are the levers we look at with clients. Timing the sale. If you have control over when a gain is realized, spreading it across multiple tax years rather than recognizing it all at once can keep more of it out of New York's highest brackets. Tax loss harvesting. Realizing losses elsewhere in your portfolio in the same year you have a large gain can offset some of what New York taxes you on. Direct indexing. This is a strategy specifically built to generate harvestable losses year after year inside a portfolio. Since New York gives you no discount for holding long term, the only real lever on the state side of a large gain is offsetting it with losses. Direct indexing is designed to do exactly that, and it works better in high-tax states like New York than almost anywhere else. Charitable giving with appreciated shares. Donating appreciated stock directly to a charity or donor-advised fund avoids capital gains taxes at both the federal and state levels while still allowing a deduction at fair market value. Residency planning. For some people with very large gains on the horizon, the timing of a move out of New York is worth evaluating well before the gain is realized. New York residency rules are strict and timing matters a great deal here. None of these are universal answers. What makes sense depends on your income, your timeline, and the source of the gain. And the math needs to be run before the sale, not after. If you have a large gain coming and you have not modeled out what New York is going to do to it, that is exactly the conversation we have with clients. I'm Joseph Carbone, Certified Financial Planner Professional, and until next time, see ya.